You can turn your camera off if you want. I'll ask you to turn it back on when we do questions. If you want to turn your camera off now, that's fine. All right, so here we go. Last week was a pretty straightforward week in the sense that the market went up and open interest expanded without fail. These type of weeks are easy to identify. I mean, they're easy to analyze because everything is one way, and it's a question of you're measuring degrees, you're not measuring direction. So if there are weird moments, they will stand out. There were no weird moments. There is one nuance, but no weird moments. I would like to start off by saying thank you for the charts, Randy. And he and I had a quick conversation, uh, and it was in his. It was on this page, I think, right? No, not this page. Not this page.
So is that
This
your OnlyFans page? Is that it?
no, my only hey, we don't.
So sorry. Oh, off topic. Wrong. Sorry.
Wait, listen, I used to have a.
That
I
was
used to have.
funny.
I used to have a. I'm sorry, what?
That was funny.
It was not funny.
It was.
That's
It
the
was
coffee.
spot on. It was the way to start the fall, man. I'm living for this.
Thanks, Lean.
Good. Thanks.
Green start.
Both of you. All right. So thank you very much, by the way. It makes it easier for me. I don't have to be drunk to do this. We were talking about macro discretionary coming in. Quick conversation, Randy and I. It might have been in the chat. I forget where it was. And you pointed out, what did you point out about open interest, Randy? Where it made its low?
Yeah. Jackson Hole last 2 weeks ago, 821.
Yeah.
On the spreadsheet over there, let's see. You don't have it. You scroll up just a little bit, couple lines.
No, I'm not going to move around on the
Okay.
screen. I just want to
Yep.
Randy
Jackson-
noticed that the low in open interest was at Jackson Hole, and that was it. So we know Jackson Hole was the macro discretionary's moment to come back in, and Jackson Hole was here. And then they started coming in. For some reason, they wanted to come in on September 2nd. Well, that actually makes sense because it's a new month. But you could see this is it. The low of open interest was Jackson Hole. Anyway, I think it's a really nice call. It also ties in with what you were saying before about few or low non-commercial shorts, right?
Right. 2 weeks ago, if everybody remembers, we pulled up that graph, the non-commercials versus the longs and the shorts, and I said, just observingly, that shorts were afraid to step in. They were afraid to add to any short positions, and seemingly that's
Right.
what's happened.
Don't take a bow on that one yet. The thing is, nobody was playing before Jackson Hole. Nobody. This week, the short funds got shorter. All right.
Yep.
They got back in. So you just know that I'm not saying they made money. They're going to cover tonight if they haven't already. But everybody was waiting for Jackson Hole. It was like some sort of a party for everyone. So I think that's interesting in the sense that there was a uniformity of behavior. Anyway, okay. So my obsession about people's behavior aside. Where's my thing? Right, so let's go through this quickly, and then we could spend most of the time on questions or observations. All right. I'm going to go through the days one at a time in cursory fashion. Then I'm going to go through the futures only and say what happened, who did what to who. Then I'll go through the options, who did what to who, because there was options activity. And then I'll go through the options versus the futures. There's some nuance this time. It's cool nuance. There's also some nuance in one or two of the days in here that shows that longs were getting out while new longs were getting in. You know, I would call it weak hands to strong hands. You just don't know who the weak hands and strong hands are. Well, it looks like the strong hands are buying it still. And there's the open interest. There's the bottom. And then I have some notes. I did a little bit of analysis. The heart, by the way, I just want to mention the HeartNet one. This is my plug. It's phenomenal. And you know, it's phenomenal because I love it. It's not phenomenal for any other reason. But he is going through We can talk about it later, but I just want to mention it up front. Uh, he is he is now playing out the 70s, and he put some insights in there that I had not known. And the reason I'm excited about this now is because when I first started doing this, the first decent analyst uh, that excited me wasn't Hartnett. It was Zoltan, right? And I had been reading Zoltan for years, but it was a snooze fest because it was always about the plumbing of the Fed and the bond market. And then he touched on commodities. I'm like, wait a minute, this isn't his area. And so I started reading it, and it got interesting. And then I started to read Hartnett closer because the markets were getting good. And I went, oh, look at Zoltan's really, really, really big picture. He doesn't commit to anything, but he gives you ideas. And then Hartnett at the time was, in my opinion, strictly macro. The open interest is not the open interest. He would say, he'd say 80% of the time this does this when that does that. Like he would very macro. Policy's going to lower rates, stocks should go up. Very macro wonky. And at the time I was like, Posar is the big idea, which by the way, I'm not filleting him. Posar gets his information from Perry Marilling. So he's a student of someone too. So Posar was all over the biggest picture, right? And Hartnett was in the macro, and I was looking at the two of them, and I was watching their topics, and it was like Posar was like in the clouds, and Hartnett was 80% of the time this. And as time went on, I saw Hartnett getting better, meaning he wasn't bad, but I saw Hartnett recognizing very early, not extremely early, but very early that he needed to start looking at the bigger secular picture as drivers for the current events. And now, in my opinion, he's in my opinion, he's better than Posar. He's just impossible to read. Anyway, so if he's listening to that, he could send me the reports on Wednesday so I can share it with you guys if he's listening. I know someone over there is listening. I don't know who. All right, so there we go. That's what I wanted to say. Here's the week. Oh, good. That's big enough. So it's a 4-day week because of the holiday. Let me clear this out. And Perry Marilling, Iggy, he was a Fed guy. And if you read his stuff, I mean, you haven't been here forever, but early on, he would throw Perry Marilling. And I'm like, who the hell is that? And you look it up and you're like, Perry Marilling is the guy he gets his ideas from. Okay. Um, uh, Mentor. I don't know where Perry is now, but anyway, Perry Marilling's the guy that he would walk up to and say, "What should I read?" And Perry would say, "You should read this book. You should read that book. You should do this." And the next week he comes back as a good student, Posar, and he says, "I read this. I understand that. I'm going to write about it." And anyway, that's how it works. Everyone has a mentor, right? Okay. All right. So here's the week. 4-day week because of the holiday. I would call this a trend week higher, which is actually a technical term, literally like technician's term. But all it means is that the market almost literally closes on the high tick of the week. It doesn't retrace more than X% on any one day. It depends on like who measures it. And it starts out after the first period. The first period would be like the A, B, or C period. Call it after Tuesday, because it's a week, it doesn't go down. That's it. It can go down before Tuesday. It can't go down after Tuesday. And the last 3 days are, assuming that was a week, those last 3 days are what you would call a normal variation, which means a range extension, but the market goes both ways. And that's where you see in those 3 days your first concern. I'm not concerned, but I'm just letting you know it's not a rocket ship, it's a rocket ship on pause. And then it started reasserting right away. Again, there's nothing negative about this. What we saw in the first 4 days is, looking at Randy's chart here, on the 27th, up 5,000. On the 28th, it's a small number. Let's just go to my numbers here because these arrows get in the way. On the first, all right, so here we go. On day one, the market's up $7. See, when you have a week that trends in one direction, there's really nothing to obsess about. And so, as an obsessive person, I need to find something. And I'm looking for how much open interest moved the market this much. 50,000 contracts came in and the market rallied $1. Well, that's not bullish. You follow? So there's nothing else to obsess about. So you obsess about classic macro discretionary technical stuff. All right, here we go. Day one, the market's up $7. Open interest goes up by 5,000 lots. I note on that day there are new aggressive shorts. I noted this before I looked at who sold it and who bought it. There are new aggressive shorts, meaning the market was at the top of the trading range. Here, look at this. It's so obvious. The market's at the top of the trading range. Oh, I didn't mean to do that. The market's at the top of the trading range, right in here. Well, it's not even at the top of the trading range. It's at the top of this interim trading range. And that's this day right here. $7 higher, long wick below, someone buys the dip, but people short it because they're looking at this range. They're saying, oh, we're in a range. I'm going to short it. And sure enough, they shorted it. And so you had new longs and new shorts getting, but you also had some longs getting out because it was, hey, we're near the top of the range. Let's get out. People who range trade will do that. That's the first day, right? Second day, the market's up $25. Open interest goes up by 7,000. Okay, so now we're off to the races, and we're actually still below the tippy top of the range. Okay, day three, I'll put the chart up in a minute again. Day three, we're up $33, and we settle just above the top of the range. And that's this day here. All right, we settled just above the top of the range. All right, I'm doing play. You got to do play by play on these, otherwise you can't get anything out of them. All right. So on day three, the market's up $33 and open interest goes up by 15,000. And you say, I said, first day is your baseline, $25 rally from 7,000 new longs. Second day, $33, 15,000 longs. The market's already absorbing some of the selling. That's not bearish or bullish. It's just something to note. You can't look at any one day on these things. Third day, well, screw that. That negates the day three. Day four, $82 on only 21,000 contracts. Everyone who's normally selling, in this case, the bullion banks, they backed off. They went, oh, let's let it breathe. And let me tell you something, they're going to be more likely to let it breathe now, too, at least in this stage of the game. Day five, the market's up $24 and open interest is only up 1,800 contracts. Interesting, right? Doesn't take much to move it. Now that means on day five, you got short covering. Oh, day five is, I'm sorry, we're doing a 4-day range. So day five is short covering. So here we go. Day one, longs get in, new shorts sell it. Sold, we're not going higher. Day two, the market picks up, it rallies, and shorts are selling, but they're backing off. Day three, shorts stop selling, they begin to panic. Day four, shorts are panicking and they're covering. Day five, market rallies on, this is a huge rally on 21,000 contracts. Day five, market rallies, what did I say, $28? $28 on 1,800 contracts. You see this day here? Here's your nuance. This green day right here, the first day of the 3 days, that's the day where the first selling came in from longs taking profits. Okay, so the market rallies, right? But open interest only goes up by 1,800 lots because you got fresh longs buying from old longs. It's very interesting. Now, in the past, actually not in the past, I'd still say it. Had this day been negative and the next day been lower, I would say that's the top, right? The sellers were strong hands and the buyers were momentum funds. But this is a different market. And the momentum funds are making money because the banks are on their side. All right, the next day is a red day, but it's an interesting day. Where is that? The market is down $16 and open interest is 5,900. That's new shorts selling to new longs. It's fantastic. It's fantastic. So this is, again, I swear to you, I analyzed this before I looked at the numbers, and when I show you the numbers, you're like, oh, Vince, you were right. Exactly, I was right. I get right once in a while. But this one here, that's new longs buy it, right? Because look at the day. It's just classic. So you have a red. If you can't see it, I'll draw for you. It's a red candle with a long wick below and barely peeking out at the top. So the market opened here, went down to here, and back up here, right? So the market opened here, maybe some long sold, but some shorts started to get in as it dropped. And they sold it here. And somebody caught it. And that could have been the bullion banks. It could have been macro discretionary. But I'll tell you, it could have been the bullion banks. It could have been the short bullion banks because they're long gamma now. That's why I'm so animated today. Where are we next? We did that. We did that. So the red day, there's your red day. The last day is markets up $48. Is it 48? 38. $38. Wait, it's 48. $48. And open interest up 10,000 lots. So now we're in a reigniting momentum. Okay? So that's that. Are there any questions about that? I'm not looking at any questions right now, but I mean, I haven't been. So now, if you have a question about that, ask me now, and I'll look at the chats right now before I move on to the next part. If not, that's fine too. Okay. Yes, Richard, that's going to come up. That will come up organically in this process. Yes. Oh, yeah. I'm going to explain it because I'm excited about it, right? I'm definitely going to talk about it. Okay, but you want me to actually go through the gamma part. I understand you're not just looking for what they did. Are you looking for a little bit of an explanation? Like, how does that help them? How does that hurt them? I would assume that's what you want. Wouldn't banks being long gamma result in resistance above, or did you mean they're long gamma below? Yeah, good question. Good question, Tony. Gamma questions, hold it, ask them again. I have very specific answers for you on those. That's a great question. Normally, how about this, Tony? I'll give you the normal answer. When I'm long gamma and the market rallies, that creates resistance above. Yes. When I'm long gamma and the market drops, that creates support below. Yes. But this is going to be different, and I'll explain why in a minute. It's not rocket science. You have a basic understanding of it. All right.
Vince, this
Yeah.
is Iggy. I sent you a private question a few minutes ago, and I'm guessing you didn't see it. I think it's a simple answer.
Is it before the Posar student question? Oh, wait, I see. Oh, I see. I didn't know this. I have a private menu. They used to show up on my screen automatically. Hold on, just give me a second here. Oh, look at that. You want me to read it out loud?
Yeah, sure.
Okay. So when shorts come in day two, what kind of option strategies are they often using? Is it simple, complex, or very complex? Okay, so when new shorts come in, the first wave of new shorts in gold, as opposed to oil, the first wave of new shorts in gold will do two things, and almost always only two things. They will sell futures as the market drops, they will sell weakness, or they will sell calls in a rally because they're trading the range. So range trading short side players like to sell calls in the rally, hedged. They think it'll just drop. And momentum shorts will sell it lower. If this were oil, because I know they understand oil and stocks, if this were oil, they would be put buyers when they got bearish. This is a call skew market, which means, among other things, it means players want liquidity on the call side. So what ends up happening is funds come in and say, I want to buy some calls, and the short players go, okay, I'll sell some. That's how it works. Does that answer your question?
Yep, thanks.
All right, good. Now, how do I get back to the regular chat? Oh, there it is. Okay, good. Wouldn't banks be long gamma result? Yeah, I answered already. Okay, fine. I will get to those gamma questions. By far the most interesting thing for me today. All right. So when you get this, the little one is a blank if you want to work with a blank. Here's the big one. All right. The red lines are for me, and if they look sensible, I'll talk about them. The red lines are if the market is up, it's not about who's long and who's short. If the market is up, the red line starts with who initiates the trade and it finishes with who takes the other side. So on this, you essentially have the longs all buying from people who historically are short. So longs are adding and shorts are adding. Longs are adding and shorts are adding, which means open interest goes up, right? That's genetically what happened here. Now, within the longs adding and shorts adding, the longs were buying from the banks. That's the market making. I think it's going to go up. I'm going to buy it. And the bank says, I'll sell it to you, right? Doesn't mean they're losing or making money. It just means they'll do it. That's their job. Now, there's a smaller contingency, those funds that were short. The funds that were short in a rally will frequently, because it was a rally, right? They will frequently cover. The shorts cover because they're nervous, right? But then there are other shorts, deeper pocketed shorts, shorts that view themselves as more savvy, more sophisticated. They're not momentum traders. They're regression to the mean traders. There are two types of traders in a moving market. There's trend traders and range traders. So trend traders are momentum traders. It's going up, I'll buy it, it's going to keep going up. Regression to the mean traders, that's my phrase, RTM, is when it goes up, it's going to go back down. They trade the cycles. Okay, so in this right here, you actually see, well, I mean, it's an example, but in this right here, you actually see, if you're not familiar with this, I'll just do this for you. See the red rectangles, the red squares? The red squares are around people who sold. Just sellers get red squares today. If I finished the whole thing, green squares would go around the other ones. So everyone who's a red square is a seller. Everyone who has no square is a buyer. And what you'll see is every arrow originates from a no square and every arrow terminates in a red square. So in my multicolored world, I'm looking at that going, in my mind, I see the graphic, like the shorts, for the most part, the longs added and the shorts added, right? Okay. And the market's higher. So everyone who bought made money. Now you're thinking about the money. Everyone who bought made money and everyone who sold lost money, except for the idiots, meaning the ones who sold it first. So who were the idiots? I mean, usually I can tell you who the idiots are. The idiots are, let me change colors so it doesn't. That's green. All right, so let me go to disappearing. All right, so I say idiots because that's just me being a trader and a snob and an alpha type of person. It comes back every so often. The idiots were, now, here's the sellers. This first seller here might be the smartest money. They sold futures. Now, it's not necessarily their total position, but they sold futures, right? These are producers and end users. These banks sold 11,000 futures. Are they idiots? No, they're producers. They sell it. That's what they do when it rallies. Now, did they sell a lot more than normal? Yeah, they kind of did. I wouldn't say it's a lot more than normal given the move, but they are still hedging production directly and indirectly. Guarantee you they're still hedging production. Maybe they're near the end. Who knows? Or maybe they just got smart. Now, over here, what do you got? These are swap dealers. This is the big managed money. I'm sorry, this is managed money, which includes big and small. And this is other reportables, which is generally very big. All right, so I'll go through it again. Producers and end users, bank employees, hedge funds, global hedge funds, at least the ones that we get to see. Okay, so now we're in the swap dealers. The bank long swap dealers added. So smart money added. Smart money took profits in the rally. And these guys, they're always smart. So you just can't really care about them because they're selling because they can, not because they are greedy. Now we go over to the swap dealers, the short swap dealers, the ones that matter the most historically, and they sell almost 12,000 contracts. Remember that number, 11.9 thousand. That's a lot, but it makes sense. In fact, take a look at this. The short producers sold 11,000 contracts, and the short banks sold 11,000 or 12,000 contracts. Essentially a 50-50 split. That's not how it used to be. It used to be 80% was sold by them and 20% was sold by them. Why? Because these guys would sell it to everyone on the floor and in the screens, and then they would buy it directly from the producers. I'm telling you, giving you a little bit of insight, that the producers are hedging their own shit now. They're also doing it through the banks. They have to. That's the relationship. I have to do my banking with my bank, right? But by the same token, they're also doing more on their own. It's You're witnessing the decentralization of the sell order flow now. Anyway, now let's go over to the funds. Managed money, your regular managed money, that includes your small CTAs, your idiots, and your medium to larger size CTAs, less idiotic, and your regular hedge funds. They got long 20,600 lots. Stupid money is in charge. And by stupid money, I mean they could be right for a long time, but they buy it because it's going up. This is not Warren Buffett trading here. I mean, within this, Warren Buffett could trade, but he's not the one buying it at the top. However, short managed money, the guys who habitually play from the short side, added 1,000 contracts. Interesting. So during the 4-day period in question, shorts added. And on day 5, day 6, and day 7, they covered. That number is lower now. It better be. All right, so let's move over to the other reportables. These are your bigger hedge funds. I usually say global macro is in there. Let's put it this way. Global macro is in here, but it's not all global macro is in there. So that's a taste of how big global macro is. Some global macro doesn't trade futures. They only trade OTC. And so the buying that, you got it's stuff that I don't see anymore. Okay, so they bought 19,000 contracts. So I'm just giving you an opinion here. If the dumb money bought 20,600 contracts and the really smart money bought 19,000 contracts, well, that makes them dumber and it makes them smarter. So in general, I have to say everyone's IQ is pretty high here, or because they're making money. If they were losing money, it'd be pretty low. And what happens to the other reportables? Classic. Other reportables who say, we're near the top of the range, I'll punt some. They sold 3,700 contracts. It's perfect gold. Market rallies, open interest goes up, funds get long, macro discretionary gets long, banks get short, producers get short, and then within the refiners or end users, they take some profits because they're disciplined, and then the bullion banks get long. These guys are talking now. These guys are talking all the time now. And I think it's going to stay up there. And so here's my conclusions before. How do I get rid of all that shit up there? Here's my conclusions. Does that go away? Yeah. Here's my conclusions before looking at the options. No, I'm sorry. I looked at the options, just not in combination. Let's move to the options. This is options. I'm not looking at options versus futures. We're not talking about gamma here. Okay? We're talking about delta. What's the difference? Delta is they got longer or they got shorter. We'll talk about how they got longer and got shorter in the gamma section. It's easier to see here. You can see all the origins are getting long. Same pattern, just a little bit cleaner. I made it cleaner. Longs are adding, shorts are adding. In a rally, in a sell-off, it will be longs are selling, shorts are covering, right? Longs are almost always the ones who initiate for the most part. So what do we see here? This is the reason I'm breaking this out now for the guys who've been here for years is because ultimately this is what happens. this is what happens. Because people don't look at their options versus their futures. They look at their position. That's just how I look at it. All right, so here we go. What happened on the week? Well, in the week, long managed money bought 20,000 contracts, and long other reportables, macro discretionary, bought 21,000 contracts. We'll get to the differences in a minute. So that's 40,000 contracts. Who'd they buy it from? Well, they bought net 8,000 from the short swap dealers. Remember the short swap dealers had a bigger short? What did I say, 11,900? Well, it's less. These fuckers are long gamma now. It's beautiful. I mean, it's limiting, but it's not limiting yet in a partial response to your question, Tony. So just working with the delta. On the week, look at this. Look at this. On the week, let's go right to left on this one, okay? Because this is where the order flow came from. Other reportables got long 21,500 deltas, which means longs, which means options and futures combined. We don't care about what they are, but we know that they got longer 21,500 contracts. They bought 7,600 of them from the other reportable shorts. These guys got, excuse me, fucking hosed. These guys got killed. All right, I'll explain why in a minute. All right. Now we move over to the left. We've got 20,000 managed money longs, right? They get long, 20,000 contracts. Managed money shorts really net did nothing. Remember, they got shorter 2,000. They really did nothing. You know why? Because they covered shorts on their calls this week. These guys actually got smart for a change. So staying with this long managed. So macro discretionary buys from macro discretionary shorts and buys from swap dealers. Long managed money buys from swap dealers, and from producers. And lo and behold, net on the week, the smartest money got smart. So net on the week, we'll do the gamma on this in a minute. Net on the week, long refiners got long. Short producers got short. Long swap dealers were pretty much flat. Short swap dealers got short. Long managed money got longer. Short managed money watched from the sidelines net. Long other reportables got long. And short other reportables got shorter. All right? So that's really how people's positions changed. And you look at it and you say, it doesn't really match up. The numbers, the math doesn't add up. That's because of the spreading. Scott, is it because of the spreading or was there an options expiration?
Yeah. Hi, Vince. Yeah. Yeah. No. Yeah. There was an option expiration on the which was interesting in itself, actually, on the Tuesday, I think. So either Monday or Tuesday.
30,
I think it was Tuesday.
was that the 30? That was the 3,500 day, right?
Yeah. Well, the interesting thing, well, to digress.
Yeah, no, you can do it.
One of the other guys on the chat noticed there was a pattern, and we talked about the charm in the market, and it was a pretty light expiry, but it actually, the market didn't behave as it usually behaves into expiry. It was rallying into expiry, which I thought was quite interesting.
Yeah.
But why do you think the swaps are long gamma? It looks to me like they're short calls.
Yeah. Let's go through it. Let's go through it and do that right now. Okay?
Yeah.
I mean, maybe I had a brain fart and I got it wrong. Let's see. All right. So now let's forget my conclusions because they could be wrong. I'm being questioned. All right. All right. So here we go. Gamma. I'm going to go through this slowly because I want to make sure I'm right. Let's start with the ones that matter. All right, Scott? Swap dealers in a whatever it was, $200 rally, got shorter 11,900. But they really only got shorter 8,600. So either or, Scott, their long gamma or they bought calls naked. You follow?
Yeah, yeah. I mean, from an accounting perspective, I
Yeah.
think the only thing that can show up in that short column
Yeah.
from a delta, because it's deltas we're talking about, is
Right.
long puts or short calls. And given that the whole magnitude of the delta is less than the futures, I
Yeah.
can't think that it's long puts,
No, it's
which
not.
have lost delta from the rally. I can only think that they bought back short calls. That's my interpretation
Right.
of the
Right.
arithmetic.
No, okay, okay. All right. So I see we're not differing here. All right. You're saying genetically they're short calls. And
No. I agree. Genetically, they're short calls. I mean,
right.
they have to supply calls to the street. But I'm saying from an accounting perspective, the only thing
Mhm.
that can show up in the short delta column, right, from a delta, not in spreading, but in the short column, would
Yeah.
be a long put or a short call, right?
No,
That's what we're
no. I mean, yes, we're confusing open interest with net delta. We're not going to go down a rabbit hole here, but I think I can explain this
okay.
clearly. I can explain this clearly. Right. Everyone, I believe I'm getting this right. What Scott is saying is that if you're a short player, then you're a short player. And if you're a short player, you're not buying calls and getting long calls. You're covering short calls. Is that what you're saying? I'm being very specific here.
Yes, from an accounting perspective,
So
that's
I'm going so now here's why
from a CFTC accounting perspective, that's what I'm
right.
saying.
So here's where I'm going to disagree with you. And we're talking disagree on nuance. All right. I'm a swap dealer. I have no position and I sell 1,000 futures. What's my delta the next day? Short 1,000, right? In the negative swap column, right?
Yeah.
Okay. Now, same day, I sell 1,000 futures and then I buy one call. And let's say that call is a 100 delta call. Okay. What's
Yeah.
my column say? What's my column say?
Well, 10% of your position gets moved from short into spreading.
No, not 10%. It's only one, not
Well,
it's
I thought it's 1,000 futures, and then what do you say? You can buy one call.
no, by one 100 delta call. You follow?
Okay.
You know what I mean?
Okay.
I want to keep it 1-to-1. You follow
Well,
me?
so that's 10%, right? Your 1,000
No.
futures.
See, you did a lot of equity work, right?
Yeah, I've done equities. Yeah.
Okay. Well, I'm not saying you don't understand this. I'm saying in the commodity side, one call is one call, and one
Yeah.
call becomes one future, not 10 futures.
No, but it's the delta of the call that matters, right?
Well, yeah, that's why I said it's a 100 delta. If it's 100 delta, it's a 100%. We're just working with decimals here. All right.
Yeah.
This is my lingo. 100 delta call means the call has a delta of 1-to-1 with a future. So if I'm long, for me in this, since I'm steering this in this conversation, if I'm long a 100 delta call, I'm long the, let's say, the 1,000 call. It's 100 delta. And if I'm long one of those calls, it equates to one future. It's 1-to-1.
Okay.
So if I'm
So are
short,
you now saying your delta flat?
no, but if I'm short 1,000 futures and I'm long one call, I'm short 999.
Oh, I see. Okay.
Right?
Okay. Well,
It's all
one of
about what
those goes, but one of those has to go to spreading then. So
are you
1% of your position moves to
I'm not,
spreading.
I'm not challenging you. Are you sure it has to go to spreading?
Yeah. Yeah. Spreading in the futures column will be calendars.
Okay.
Spreading in the option column will be delta hedged.
Okay. All right. So that's
That's
I
my
know it.
interpretation, right?
I believe you're probably right. It's been a really long time since I paid attention to that part of it. So let me refine this for everyone and let's at least make sure we're on the same page. All right. All right. Swap dealers got shorter 11,900 futures. I know where this is coming from. I said they're long gamma. What I really mean is they got less short gamma. That's what I mean. You follow? They covered some calls.
Yeah, that's what I think.
That's
Yeah,
what
I
I'm
agree
saying.
with you.
All right. All right. Jeanette, all right, let's, for everyone here, all right, for everyone. Swap dealers who play from the short side are genetically short calls or long puts. Okay? They have to have net delta shorts in options. Now, they sold 11,900 futures. But when you net the futures against the options by the end of the week, they really had only sold, which, by the way, that number is 11,900 futures. We're going to call them deltas. When I say delta, think futures plus stuff that acts like futures, right? So they're short 11,900 deltas, which is futures and stuff that acts like futures, right? The market rallies and they're only long, I'm sure they only sold 8,600 deltas. So we know that they sold 11,900 futures because this is futures only. But when you do it in deltas, it's futures and options combined. They bought options that they were short. They covered shorts. Everybody with me on that? Scott, first, are you with me on that?
Yeah, I am, and I think that that ties back to our conversation about the 3,500 strike, and now that
Yeah,
there's room to breathe, right? Because they're covering.
yeah. No, absolutely, absolutely. And I'll give you the tactics on that. Remind me about that, what you just said. I'll give you the tactics on that in a second because I used to witness that firsthand, especially with a light month. When a light month went off, you would see an uptick in activity by people who had a band-aid covering a bullet hole, like a time spread to cover a short. Okay, so now I'm coming back to Tony. I haven't read your thing yet, Tony, right there, but I'm coming back to Tony. I'm going to hopefully preemptively answer it.
So, sorry, and Vince, just to throw something more in for you to think about in your answer to Tony.
Of course.
There was that massive GLD call spread.
Yeah, I wasn't.
Huge.
I didn't see. I missed that totally. I was up to my neck.
Some guy put it on the chat as well. Actually, I mean,
Okay.
It was almost as big as whoever it was who bought that position in GL, whether it was Saudi or whatever, who bought that position in GLD. It was huge.
Really. Well,
It
then
was a mid-September call spread. Yeah, sorry. Anyway, I'll shut
no,
up.
No. That's going to be part of the nuance. Then I didn't know that at all. That's going to be important. All right. So let me answer what I think Tony's going to be asking, or what he has asked, or at least answer his last question, and then we'll factor in the flows. I'm telling you, Scott, you ready? I'll get this over with. You and me, you ready? Oh, look, a customer bought a fucking billion GLD calls. I think I'll buy 2,000 calls and cover some shorts. They start front running their customers on the long side now. That's what they're doing. All right, so Tony. So Tony, they sell 11,500 futures. Futures plus options. I'm sorry, where is that? It's over here. 11,900 futures. They sell on the week, though, really only 8,600 futures equivalent. So they bought 3,000 deltas in option form. What did they do? They went out and bought calls and didn't hedge them. Now, to your first question, I haven't read your second question yet. To your first question, don't they have positive gamma now? Wouldn't that cap the market? Yes. If they flipped from short to long gamma, it flips. But, and I'm saying this to you because this is where I'm not sure that I mean, I think Scott's right. I just want to, how they measure risk at the CFTC is not how I measure risk. If I'm short 10,000 futures, I guarantee you when I was trading options, I would be short 5,000 futures. And I was still long deltas because I was long so many freaking calls that when the market went up, I made money. Right. So I would make money being short futures all the time. I always had margin, variation margin. Anyway, what I'm trying to say here is, coming back to the normal question, is that you can assume with 90% surety that in this rally, the banks who are genetically short calls to begin with, they could be buying puts, but they're not. It's a call market. There's puts involved, but not yet. Or put it this way, there was puts involved 2 months ago. They saw something that freaked them out and covered. This is what we would say. We covered some gamma that we were short by covering deltas. We covered deltas and covered gamma. What does that mean? It means you bought options and didn't hedge them. Okay? So that's That's your first question. Just, Tony, type to me if I haven't read your second question yet. Type to me if I've answered your first question. Right. So your question is, well, if they're short gamma, it should accelerate going higher. If they're long gamma, it should slow it down. Right. They're just less short gamma. Right. Okay. They just want to make money. All right. Let me read the next question here. I see the other ones in here too. If you answer some more depth, why does someone get long or short gamma? What's the goal or point? Okay, Iggy, short answers, but clear answers. Um, um, when I say the word gamma, I want you to think volatility. It's not the same thing, but I want you to think volatility. I get long and short gamma. I get long gamma because I think the market's going to move. I get long volatility because I think the market's going to move. They're not the same thing, but gamma is what makes your delta change. So, for example, I'm long. I'll give you a little bit more here. I'm long volatility. Am I long gamma? Yes. Why? So, what is that? When I say to you, I'm long volatility, am I long gamma? And I say yes, I'm saying to you that I'm long options. When I say to you, I'm long gamma, but short volatility, I'm referring to something called time spreads. I'm long short dated options and short long dated options. When I say to you, conversely, I'm short gamma and long volatility, that means I'm short dated options and long dated options. All options have gamma. If you buy an option, you have positive gamma. If you sell an option, you have negative gamma. If you buy an option and you have gamma and you're hedging gamma, you think the market's going to move, you don't know in what direction. If you sell an option, you have gamma, you think the market's not going to move and you don't have direction. Gamma manifests when the market moves and changes in delta. Now, it gets much more complicated when you start looking at I buy one option, I sell another option. What is my volatility position? I'm long volatility. What is my gamma position? Well, it could be long, it could be short, depends on the structure. So in simple layman's terms, gold is trading 3,600. I buy the 3,600 call. Am I long gamma, Iggy?
Yes.
Right. Okay. Now, same month, same expiration. I sell the 3,800 call. Am I long gamma still? Look at me.
I would have said you were less long gamma, but
Right.
not.
You got it. Okay. You got it. Your understanding is good. Right. I'm long the 36 call, which has the most gamma, and I'm short the 38 call, which has a little tiny bit of gamma. And let's pretend that I have no delta risk. I've hedged it. The market goes from 3,600 to 3,800. Now it's trading 3,800. Am I long? Forget about deltas. Am I long gamma or short gamma?
I would still say you're long gamma, but it's a narrower spread to what you were when you bought it.
No. Unfortunately, no.
Okay.
I wish that were the case. No. Wait. Watch. I'll piece it together for you. You are assuming on some level you are associating gamma with profits. Don't do that. I'm long the 3,600 call and I'm short the 3,800 call. The market's trading 3,600. I'm long gamma. The market goes to 3,800. I'm now short gamma, but I have a shit ton of money in my pocket. Do you understand?
Yeah, let me interject something. Tony gave me a what I think is a good answer that helps explain why my answer was wrong, because gamma is the I don't think I and several of the other people on here have really pithy definitions of what it is. So
Right.
if gamma is the rate of change of the delta, well,
Right.
the delta has narrowed, so gamma has gone lower.
Right. So that's exactly right. So I'll put it in that perspective. I know some of you are engineers and gamma and delta, all they really are is speed and acceleration. Or in physics, they're delta, like in physics, change, and then they're delta of delta, rate of change and rate of change of rate of change. Speed, how fast is the car going? 50 miles an hour right now. But if we measure it a mile from now, how fast is it going? Well, 100 miles an hour. That's because you had gamma. Acceleration is gamma. So if you're looking at it from a trigonometry or calculus point of view. No, let's stay with layman's terms.
Oh wait, can I interject just to clarify that point?
Let me finish my thought. Hold on.
Okay.
All right. So delta is the rate of change of the instrument. So my delta of this call is 50. So this call has a 50% correlation with the market. If gold rallies $10, this rallies $5. It's a correlation trade. All right. Now I say, well, it has a 50 delta. How much gamma does it have? Well, the gamma is how much does the delta change when the price moves in the thing. So the market trading 3,600 and the call has a 50 delta. Because it has a 50 delta because if the market rallies $1, it rallies 50 cents. If the market drops $1, it drops 50 cents. It has a 50% correlation. Delta is percentage correlation with the underlying. And that's how you make your money, by deltas. So if I'm long a future, what's my delta? 100, because I'm long 100% correlation with the future. If I'm long a 50 delta call, it's 50. I'm long a 50% correlation with the future. Gamma, before Iggy comes in here, gamma is this. The delta of my call is 50. So if gold rallies $10, the call goes up by $5. We're not talking about volatility here. All right? We're not talking about volatility. What's the delta of the call when gold rallies $10? Well, the delta of the call is more than 50 now. Why? Because it's in the money. The delta of the call is actually closer to 100, which means the delta of the call was 50 here when the market's trading here. And when the market goes up to here, the delta of the call is bigger because it's in the money. So the delta of the call is 50, 51, 52, 53. So every uptick in the market, the delta increases. So by the time it gets to 3,700, the delta is 60. The delta of the call is 60. The first delta was 50. The last delta was 60. The gamma is the difference. The gamma is the acceleration. The gamma is 10. Hold on, Iggy. Does anybody have any questions about that so far? You're not going to get it all, but you'll get it as time goes on. It's why your options make more money as the market keeps going. Forget volatility. It's another conversation. Go ahead, Iggy.
Okay. No, I think I've got it. So just at the real basic level, delta is the rate of change and it is the speed. And gamma is the rate of change of the rate of change, which is acceleration. And I have a physics background, so I get that. And then let me ask, is open interest the magnitude? Or is there a magnitude measure?
Open interest doesn't fit in that calculus. You know what? If you're a physics guy, look at delta as a sine curve, right? Okay, delta is 0, delta is 50. Okay, so delta goes from 0 to 100. Okay, so delta goes from 0 to 100. Okay, gamma is the tangent on the sine curve. Gamma is the s. As the call has a 0 delta, it has no gamma. As a call has a 50 delta, it has max gamma. And as a call goes to a 100 delta, it really has like a 0 delta again. The gamma is used. It's basically where the curvature peaks on the sine curve. Does that help?
It does.
Okay. Now, I mean, maybe I'm not helping you out with the open interest, but the open interest doesn't factor into that.
No,
if you're looking at,
and let me just clarify. My question really was when I'm thinking about mass and velocity and acceleration and all of that stuff, and I'm thinking about applying that, again, it may be imperfect, but as I was thinking about applying, that velocity or that magnitude into a trade, it was really more of a question of what is the representation of the magnitude versus the acceleration or speed, I guess. And again, it may not be even a good.
Wait, hold on, help me out here. I understand everything you're saying, but the word magnitude, give me the context of the word magnitude. Magnitude of what?
Again, let me be clear. It's been a long time since I even studied physics, but we're talking about the the direction and the intensity of that direction. So,
You mean speed? You mean speed of speed of speed? Follow
no,
me?
it's again, it's what is it? Mass times velocity, or mass times
Oh,
I'm
no,
forgetting what it
forget
is.
mass. No, it doesn't factor into that. No.
Okay, so we don't have a okay. That's why I said it may
Yeah,
not.
you don't. I mean, maybe that's something that would give you an advantage, right? But that's not involved. The other parameter that you want to think about in terms of this gamma delta thing is what increments do you measure in? Do you measure every dollar? Do you measure every penny? Do you measure every dime? Do you measure every $100? Okay, right? And here's the other parameter. Gamma changes over time. So the gamma of a let's say an option has a 10 delta. You with me on that? It's got a 10 delta, which means to a trained options person's ears, if it has a 10 delta, it's very out of the money. It's not near at the money. It's not near the top of the bell curve. It's on this part of the curve or that part of the curve. It's on a wing. It's on a tail. Okay? Now, that's an option with 100 days left. It's got a 10 delta. If the market doesn't move at all and 50 days go by, the 10 delta becomes a 5 delta. So it's all about time. That's the other parameter you got to care about.
Perfect. Thanks. This is going to give me a lot to go listen to and study a little bit better.
But look, if you understand engineering, you understand physics. Here, like you should be able to really breathe easy here. The first options model by Myron Scholes, by Fisher Black and Myron Scholes, I met one of them. We used to joke about this. Assholes on the floor used to say, "It's not rocket science. Just tell me." And then, having learned this, I would say, "No, it actually is rocket science." An options model is a diffusion of gas model. That's all it is. Okay? It's a gaseous diffusion model.
Thank you.
All right, Iggy, I want to make sure.
Yeah, that's perfect. Thank you.
It's a gaseous diffusion model. It is rocket science. That's the funny part about it. The funny thing is rocket science isn't that hard. Okay, let me look through a couple of these questions before I move on to the next thing. We spent a lot on options. Scott, seriously, I break your balls, but thank you. That was actually a great question, and Iggy asked some really good questions. Now I'm going to go through the ones that people may have gotten it. All right, so, all right. Our pleasure. That's why we're here, Arena. I think it was 25,000 GLD calls. What's the strike, Richard? Do you know what the strike was for the GLD calls? If
I don't
anybody knows,
remember.
just type it or say it.
It was Vince. It was I don't trade GLD, but it was 315, 330. I don't know that might be in the money by now.
So it was a call. It was a call spread, or the guy bought both calls. That shit happens.
Call spread.
Yeah, yeah. That's
Twen-
some stout. That's a stout.
It was
That's
it
a
was
stout.
25,000
That's
times mid September expiry.
a
So
stout.
it's not a COMEX expiry. Yeah, it looked yes. It was of similar. It was smaller, but of similar magnitude to the straight out buy.
I mean, yeah. I mean, look, that's how they work. Oh, I'm gonna buy. I think gold's going up. Buy some GLD, and then his cousin who's on the desk next to him, he goes, "I'd like to buy some call." You're not wealthy enough. You can buy some calls. You can't buy futures or
Yeah,
stock.
but listen, why would the Saudis trade? I mean, look, they could trade COMEX, they could trade LBMA. Why are they buying?
All right,
This is really interesting, right? If it is them,
okay.
why
Now,
are they trading GLD? Right?
this is conjecture, but so far I haven't been like I'm running with this until I'm proven wrong. I'm very aware I could be wrong, but this is the geopolitics of it. See, there's two things going on right now. One I'm sure of, and the other one I believe. One is I know I'm not going to go down this rabbit hole, but I want to mention it. I know that now that China, we're talking about China here. China has asserted itself as a player on the global pricing stage for gold and silver. Their prices affect global prices. I believe now those players are asserting themselves in other countries. I believe, and cannot prove it, that when we had that, someone tried to take delivery of like 5,000 contracts that was stopped that time, or 50,000, whatever it was. I believe that was a player testing our resilience, our reliability. But that's complete speculation. Now I want to move forward to make my opinion on China exporting its pricing power into reality. Trump just did a deal with the Saudis and United Arab Emirates. And that deal is they have to, not that they have to, they've verbally committed to investing money in the US. Why not CFTC? Why not futures? I'm not saying they're not trading futures, but the disclosure on the futures is more dangerous because you can take delivery of the futures, right? There, and you can take delivery of the futures. There's reasons that make futures right now, more of a problem because people are taking delivery. That's the first thing. The second thing is Trump cut a deal with them. He wants them to invest in the US. Do you remember 3, maybe 6 months ago, India said, well, as part of our negotiation with the US, we'll buy more silver and more gold. They didn't say more. They said, we'll buy silver and gold to settle our trade deficit. That was a complete slap in the face. And sure enough, we've been fighting ever since. I mean, not because of that reason, but so it's my contention that the buyers of these massive GLD call spreads or silver or SLV, it's either a Saudi Arabian or let's say a BRICS sovereign wealth fund or just a good old fashioned American macro discretionary that has to operate on the equity side. So, for example, Scott, so just so you know, I'm not married to it. I'm one of HeartNet's clients, okay? And I've been buying miners for the last month and I'm making money. But I'm at a big fund. I'm at Elliott, right? I'm at Elliott and I'm in the equity side. And there's a futures guy over there and he goes, guys, it's fucking, you know this. This is, you live this, right, Scott? Guys, it's going to happen. We're going to take it up. Okay. And so I'm on the equity side. So what do? I can't trade over there because of the way the firm is run. So I go out and I buy whatever, 25,000. It doesn't have to be the Saudis. It doesn't have to be a sovereign wealth fund. But you and I both know that the very sophisticated people don't buy call spreads. They just buy calls. It's the money managers that buy call spreads. Does that make sense?
Yeah, it's interesting. It's very interesting.
Right. I mean, we're not conclusive on anything here, right, Scott? You and I are on the desk. You and I are on the desk, and we're going, who is it? I don't know. I'll bet you $5 it's him. And you'll say, I'll bet you $5 it's him. And then we have to figure it out. But we know this. We know this. It's retail behavior in massive volume. It's not retail. It's someone who,
Yeah,
right?
I mean, a short-dated call spread like that, it's like a binary, isn't it? It's like a digital.
Oh,
It's
how short dated was it?
it was something like it's not a COMEX expiry. It was something like I don't know. Listen, it was something like 15th of September.
Are you
I mean,
kidding me?
it wasn't a COMEX expiry. Yeah,
All right,
I mean, basically, I started when I saw it. I just went, well, I'll get longer, right? I mean,
yeah. Well, that's the thing, that everyone who's trying to navigate what we're talking about here, if you're a very sophisticated player, you don't buy a 15-day call spread or whatever it was. You buy a 15-day call. Why? Because let's say by the way, this is what happened. I'm telling you this is what happened. This is how risk managers who don't normally trade a product think. They go, I can put $5 million into gold. I think it's going to go up $30. It might go up more than $60. I'm going to spend $5 million on a call. Oh shit. Fuck it. I'll buy twice as many call spreads because I get more money. So he's giving a bang for the buck. Now, in my world, in this, and by the way, in the sophisticated world, forget about my world. In the sophisticated world, you don't buy a call spread. You have $5 million, you buy $5 million in calls. You don't buy $5 million in call spreads. When you're at the professional level, You don't think about conserving money. You have a mandate to spend that money. That $5 million needs to be put to work, or your boss will say, dude, you only put to work $2.5 million? I'm taking it back from you. You put all $5 million. You may not buy the same strike call, but you spend $5 million. That's not a sophisticated player. That's what I would call a professional tourist. So, I mean, look, this guy's a moron. He's a now he's classic information flow. He talks to the smartest people in the world with less than the smartest sophistication of money. And he bought a call spread. Now, Scott, now that reason I lit up because you said it was 15 days, is because here's what's going to happen, guys. It's happening right now. And I was waiting for it to happen. In every market that's in play doesn't mean higher or lower, it just means in play. Where there's asymmetric information, the short dated options start trading more. That's why you get gamma squeezes. I think, you don't think Elon Musk was doing that when he knew he'd have good earnings? He was buying the shit out of options with 2 days to expiration left, with one delta. But if the market rallied $50, the option would have like a 90 delta. They had explosive gamma, Iggy, right? The rate of change of the rate of change was explosive because they were at expiration. So I'm telling you, as this market becomes more and more live, the information flow that we get from these CFTC reports will slowly migrate to the weekly options. That's it. That's where we are. Very exciting. And it's exciting to me because I don't want to sound completely like an ass here. All right, I'm gonna move through this. 15 to 20 days. Thank you, Richard. So, Richard, did I answer your question about gamma, or enough of it anyway, to get you started?
Yeah, I think so. It's certainly given me some reading to do.
Yeah, I mean, I'm very good with visuals on this, and I'm not using visuals today, but I'm very good with visuals. It's like, um, uh, gamma is a bell curve. Gamma is a bell curve. At the middle of the bell curve is where the market is right now. So gold trading 3,600, what option has the most gamma? The 3,600 call. These could be calls or puts, I don't care. Calls or puts, I don't care, Richard. The 3,600 call has the most gamma, okay? When the market's trading 3,200, the 3,600 call has very little, we're not talking about deltas. The 3,600 call has very little gamma. When we're trading 4,500, the 3,600 call still has very little gamma because it's realized all its profits. It's lost all its profits. The 3,600 call has, with the market trading 3,200, the market goes to 3,300. What's a 3,600 call worth? A little bit more, but I don't really think it's going up that high. At 3,600, what's it worth? Oh shit, it's worth a lot, and it can go a lot higher. It's kind of like this. This is your 10 to 1. Think of it in horse track. Everything out there can be parallel with this. This is your 10 to 1 play in the horses, and this is your even money, right? 10 to 1 pays off a lot. Yeah, it doesn't cost a lot because you know what? It's not going to win. 1 to 1 pays off a lot, lots of gamma, and you can lose a lot. It's like betting the favorite. So when it's in the money, it has little gamma. When it's out of the money, it has little gamma. So deltas go from 0 to 100. Gamma goes from 0 to 50 and back down to 0. That's it. All right.
And
15.
Vince, on the gamma increases also as the option gets closer to expiration. Is that correct?
Yes, that's time. Well, oh boy, don't make me do this. All right, I'll do it. I'm going to do it. Just give me a second. I'm going to do it. I'll give you one graph to answer that. It's going to be shorter than me talking about it. All right. And I know that's what you guys all want. You guys don't want me to talk about it too much. I'm going to draw it for you. You ready? Because I should draw this. Those of you who thinking pictures or graphs, here we go. You ready? Hold on. Close
You
that.
haven't done one of these for like 3 years.
I know. Is this Randy? Yeah, it is.
Yeah.
Fucking A, man. I used to live on them because you know what? Because
Yeah.
I'll tell you why. Because as I was thinking, it gave me time to think while I was drawing. It's like, I'm like, what's his name? Bob Ross. And here's the pretty, that's and here's the pretty, we'll put some gamma here and we'll put some deltas there. All right, so here we go. All right, this is your graphic, right? So this part here, I'm not going to get details. This part here is where the market is. It's also the strike of your options. This part here is how much gamma you have. And this is your gamma. Let's assume that was perfect. Okay. This is your 3600 gamma call. This is your 3300 gamma call. And this is your 4000 gamma call. Okay. That's your gamma. Now let's do delta. Delta is your sine curve. 0, 1, 2, 3, 4, 5, 50. Okay. So rise over run, for those of you who aren't that familiar with, haven't done this in a long time. This is your delta with the market trading. Let me give you the right. So this is 3600. You ready? That's where the market's trading. But we're long. Actually, we are long. We're long the 3600 call. What's the delta of the 3600 call with the market trading? Let's make it obvious. 1000. It's 0. This is your delta now. We're doing delta 0, 50. What's your delta 3600 call with the market here at 3600? It's 50. What's your delta 3600 call with the market at, let's say this is 5000? It's 100. So delta goes like this. Delta is your sine curve. And where the steepest rise over run is, that, my friends, is where your most gamma is. A little bit of gamma, a little bit of gamma, a lot of gamma. The steepness of the ascent is the gamma. So the 3600 call, let's say we've got two axes here, right? Let's say this is delta, and this is gamma. The delta goes from 0 to 50 to 100. It goes like this. The gamma, which measures, again, the acceleration versus the velocity, the gamma measures the rise over run, the change in delta, right? So the gamma goes like this. Well, the gamma, there's no gamma down here, but as the delta goes up, as the slope increases, the gamma increases. And I'll make it a different scale. Actually, fuck that. I'll do it a different color. All right. So here's your gamma. Here's your gamma. Oh, I'm getting more gamma because I know that I'm getting more gamma because it's manifesting in more delta. And I'm getting more gamma. It doesn't have to stop here. It stops wherever I want it to stop. And at 3600, I have peak gamma. And above 3600, the rise over run decreases. And the gamma goes like this. Or I'm sorry, not down there. Goes in there. Goes down here. All right? The red line is delta. It goes from 0 to 100. It cannot go above 100. It's log normally truncated. Can't go below 0. Can't go above 100, which is why oil had so many problems. The gamma is the rate of change of the delta. And that's it. That good? I'm proud of myself. I remembered that, Randy. All right.
You should be a professor.
I should be. Oh, God. All right. All right.
Hey,
Iggy,
I threw
yeah,
a question in there. Can I jump in with one?
yeah.
It's further up the chat. So I said, what action
Oh,
Would you?
you're
Oh,
muffled. Your
sorry.
microphone's muffling. Your
Yeah,
microphone's
some of
muffled.
that. What action do you take when gamma peaks and slows down from that acceleration phase?
Well, isn't that behaviorally speaking, as opposed to statistically speaking? Statistically speaking, I start trading my gamma, which is another conversation. Meaning, if the market rallies, I sell it. If the market drops, I buy it. I'm not looking for trend. I'm looking for range trading. I actually want range trading when I want the market to move. If anybody's interested, the relationship of gamma to volatility works like this. Gamma justifies volatility. Gamma is measured by, does the market move as much as the standard deviation as measured by volatility? So if I'm long at my max point in gamma, Randy,
Yeah.
I want the market, I do my math and I say the break even for me. Break even, it's all about break even. Now people say, what's break even? Break even is a standard deviation. It's all about the standard deviation. If gold is trading 3,600 and the standard deviation is $50, I want gold to move $50 in either direction. I don't give a shit which way. Okay? Because I'm purely trading gamma. I'm not bullish. I'm not bearish. When the market rallies $50, I'm going to sell it. When the market drops $50, I'm going to buy it. I'm a delta neutral gamma hedger. Now, that's statistically what you do. Behaviorally, Randy, this is what happens. I buy a call. What's the most popular bet at a racetrack? 3-1, 5-1? Someone correct me if I'm wrong. 3-1, 5-1. Forget the long shot. That's bullshit. 3-1, 5-1. Somebody give
Probably,
me,
yeah.
right?
Probably.
Five, is it 5-1? Is it 5-1?
Well, just by default, nobody's going to go with the 25, 35, 50 to 1. So
Right.
you've got to be in that range.
So I'm going to paint a picture because I love the movie Let It Ride, which is Richard Dreyfuss. The loser bets the long shot. The richest guy bets the even money shot because he can afford to lose it. And the smart speculator bets the 5-1 shot. What's the 5-1 shot? It's the 20 delta call. What's the 3-1 shot? It's the 33 delta call. The option that's most repeatedly bought by speculators in gold is between 20 and 33 delta calls. The behavior of options trading in the gold market and every market where humans are involved is to either buy or sell the 20 or 33 delta, 20 to 33, that range. That range gives you your 3-1 to 5-1 bang for your buck. Now, what does this have to do with your question, Randy? A lot. Because the option, let's say gold's trading 3,000. For some reason, even though I'm looking at money, I'm not looking at payoff. I'm not looking at payoff. I'm looking at money. For some reason, humans gravitate towards the 20 to 33 delta call. 20 to 35. Really, it's like basically 25 to 30. So let's just say 20 to 33, right? 20 to 33 delta is where the speculative bullish interest comes. So you, Randy, and I are on a desk and we say, I'm bullish. And so we buy the 27 delta call right in the middle. Boom. It doesn't have a lot of gamma, but it doesn't have no gamma. It's in the sweet spot. But we're not measuring gamma. We're just directional guys. We're just directional guys. The market goes, we buy the 3,600 call with the market trading 3,200. The market goes to 3,600. We look at each other and we say, what should we do? Now, I'm statistical. I'll say we should hedge it and trade the shit out of the gamma. And you're like, screw that. Let's just take profits. So when a 25 to 35 delta becomes an at the money option, it gets sold. At the monies are sold because people look at the premium and say, oh my God, that's a lot of money. I don't think it's going to rally $50 from here. And that's it. You follow?
Yep. That's it.
That's so generally speaking, let's pretend there's only two people in the market, you as a directional speculator and me as a market maker. If you buy the 20 to 35 delta call, 99% of the time you're a directional speculator. And it's not cynical, it just is. It's the best bang. It's not because people are stupid. It's the best bang for the buck. And so you will buy that call and I will sell you that call. Okay? And then I will buy 25 deltas against the call. And the market will go up and it'll be a 50 delta and you'll make a ton of money. And from this trade, I lose money. I lose money. But you see, when you bought that call, I know that you're smart. So I go and I buy another call from a guy who's not so smart. So I go, let's say you're Paul Tudor Jones. Paul Tudor Jones bought the 25 delta call for me. We're going up by 25. Then I'll just go, you know what? I'll buy an extra 25. So I will speculate long because I see the smart money buying. And when it gets to be at the money and your broker asks for a market in that call, I go, he's selling. He's got so much money and profit to take. And then I just fade the shit out of you. What's it worth? It's worth, let's say 65. I go, I'll buy it at 57. And you're Paul Tudor Jones. So you say, screw that. I know you're scared. I had this conversation with Paul Tudor Jones through a phone. I know you're scamming me. I'll tell it to you for 63. They're like, who is it? It's Paul Tudor Jones. All right, fine, I'll buy it. So, but if you're not Paul Tudor Jones, I'm going to break you over the coals. That's the whole deal right there. That's the whole deal. It's I trade gamma, they trade direction. I trade volatility, they trade direction. But their direction gives me a bias as to where it's going, which, by the way, is why the Bollinger Bands became important to me. Because the Bollinger Bands were a quantification of what I just told you.
How far does Paul Tudor Jones lead me? Where is he stepping in front of something? Is that just info, that research? Is it, are they stats?
Paul Tudor Jones, I mean, I don't know what he does now, but this is what he did then. Paul Tudor Jones buys before you and I do. Speculatively. Right. Okay. So Paul Tudor Jones, Paul Tudor Jones is us. Watch. Paul Tudor Jones says the market is oversold. I want to buy some. Now we say the market is oversold. I want to buy some. And then we buy it and the market flatlines for 3 days and we get stopped out or our option goes to zero or the market drops a little bit more. Paul Tudor Jones does this. This was his style. I only know because he was very, very active in silver for a period. I mean, a long period. He was the king of cotton, but he was like the second king in silver, and he made his money in stocks. But he knew commodities better than anyone at the time. Okay, so Paul, and I know this because I spoke to his. He only used one broker on the floor, and after years, the broker told me what he would do. The broker wasn't a broker. He was a broker who understood the market better than most people, better than me for a long period of time. I'm like, so what did he do? And so Paul Tudor Jones would do this. He'd say, the market is oversold, buy it. And he would buy 5,000 carefully. He's not buying it to make it run. He's just carefully buying. Sexy, right? And then he would have a very tight stop. So the market would drop, he would buy it, and then he would put a tight stop in. If the market dropped 2 cents, he'd sell it. He'd puke. So he would take his losses very, very, not just disciplined, tight. So if that happens to me and I take my losses tight, this is to show you the type of stomach he had. I find as a speculative trader, if I make my stop losses too tight, I lose money and I get psychologically damaged and I can't get back in. My conviction gets shaken because I've lost money. Because to an extent, I'm trading with scared money, always, because it's my own. So the rule of thumb for me is never take more than 2 bites at an apple. The rule for most people should be never take more than 1 bite at an apple. So I buy it on the dip. I get stopped out. If I'm taking more than 1 bite at an apple, then my stop is too tight. I need to lower my stop so I can let it breathe on the upside. Paul didn't put his stops low. He put his stops tight, but he would take 5 or 10 fucking bites at the apple. So the market would go like this. It would fall and it would stop and it would do this. I'm like, what the hell's going on? He said, remember when the market would stop and remember when silver did this yesterday? And then I bought it and then I sold it. I'm like, yeah, I assumed it was 2 customers, right? He goes, no, same guy. He bought it. It went down. He sold it. He bought it. I'm like, well, what's he doing? He goes, he's keeping his finger on the pulse. I go, and then what is he doing? Well, there's going to be a time where he buys 5,000. That was his number. He buys 5,000 and it goes his way. I go, what happens then? He goes, when it starts to go his way, he doubles it, 10,000. And he just makes everyone panic. 5, 10, 15, 20. And then he just lets it run. So basically, buy 5, he catches the falling knife and then he drops it if it's too heavy. Drops it, drops it, drops it. But he's completely understanding that the market is oversold and it's just a matter of time, but he's disciplined about his losses. And then the market goes up. And when the market starts to go up, then all the other guys come in and buy it. Does he sell it to them? No, he buys more. Buy 5, buy 5, buy 5, buy 2, buy 1, buy half of 1, sell half of 1. He statistically scales in and statistically scales out. It was brilliant. It was brilliant. That's what he did. Remember, if you read about Paul Tudor Jones, there's like a video of him, and on the wall there's a picture and it says losers, average losers. If you find that video, what he means is you don't dollar cost average when you're trading. You get out, you reassess, you get back in. And that's something that I do. All right.
Cool. Yeah.
Iggy, no, you wouldn't recognize him. It was an individual, the best broker on the floor, and he was since suspended from the floor years ago. And he was my mentor in futures, one of my mentors in futures. He was my broker. He was my broker. He was such a good broker, and he was so professional that Paul Tudor Jones did options too, guys. So when Paul Tudor Jones wanted to do options, he would go through that broker too, and that broker didn't know shit about options. He's like, I don't know what that's doing. And he would pull me out of the ring. Vince, come here. I got a customer, my good guy. And I'd say who? And he'd say, I can't tell you. I'd say who. And after like 2 years of this, he'd be like, it's the guy who lives in a house. And I'm like, what the hell does that mean? Well, Tudor. It's a Tudor style house. So I eventually figured it out. So he'd say, Vince, what's your market in the, $7 call in silver? And I would tell him. And he'd say, okay, what's your market for 5,000 lots? And I go, well, the market for 5,000 lots is a little bit wider. I go, but I would probably do 500. I go, but if I know you're a buyer, I'm going to fade you high. He's like, I'll tell you what, this is our conversation. I'll tell you what, don't play that game with me because my customer is smart. He knows you're playing that game. Tell me your market. I'll give him my market. I'm 6 bid at 8. He goes, what's your real market? I'm 5 bid at 7. So I would sell it to you at 8 is what I'd say, but I'd really sell it to you at 7. So the conversations would end up with this. I'd say, just call him E. I would call him E. So E, what do you want to do? He's a buyer. Go ahead. The market's 6 bid at 8. If you bid 7, I will fill you, but I need you to, this is how it worked. Trade with me first because of everything I'm doing with you right now. Why trade with me first? Because I wanted to get my hedge, because everyone he traded with after me would be running in to throw futures in the ring, and you'd all get screwed because we would push the market against ourselves. And he knew that. So he would buy 5,000, 10,000, 15,000. And then he'd come into the options ring and he'd say, give me some calls. And he'd buy some calls, and we would just go whoosh, and we would push the market ahead of him. And he would love it because he was creating essentially the precursor to a gamma squeeze. He essentially invented the gamma squeeze. So didn't invent it, but that's it. That was it. I'm like, listen, you're going to buy 5,000 of these things, and I can only sell you 500's a lot. I mean, I never would sell 500. It's 250, right? So I'll sell you 250, but if you buy my 250 after these other idiots, then I'm going to turn around and buy them from them, and I'm going to buy futures, and I'm going to run your customer in. He would say, of course, I never really meant that. He would bury me. He was like the king of the ring. And he'd go, no, I'll trade from you first. And he would come in the ring. He would say, Vince, he would say Vince or Siggy. My badge was Siggy because I'm Sicilian. He'd say, Siggy, where are you on the, and when he came in the ring, people knew he represented the biggest players, and he didn't know options, and they knew he didn't know options. But when he asked me, he was using me to keep the ring honest, because the ring would just lie to him, and I would lie to him too. But I knew him. Vince, where are you on the 750 call? I'd say 6 bid at 8, and everyone would look at me and go, "You're out of your mind. Suppose he sells it." I'm like, he's not selling it. It's Paul Tudor Jones. He's buying it. This is me bragging, right? So it's 6 bid at 8, and the ring will go, and the ring will go, 6 bid at 8, I want to sell 8. So they're all like a bunch of freaking lemmings, like carps fighting over a piece of bread. Can I sell some 8s? Can I sell some 8s? And I would go 6 bid at 8, and he would go 7 bid, and I would go sold. And he'd go 5,000. I'd say 200. I'd hedge, and then the rest of the ring would tackle him to do this trade. And by the time they got the trade, silver was 10 cents higher. And I was Phil just laughing my ass off because I hedged and I overhedged and I was selling my extra futures out to the other traders that were buying their hedges for the first time. You got to be first when you're trading with the big guys or last. You don't want to be in the middle. That's the story. All right. That's it. Okay. So I think I've covered everything, right? It should go in the book, right, Richard? You're right. I'm really behind on that shit, but that's one of the stories. Yeah. That's a great war story. That's a great war story because I'll tell it with, I mean, it's fun to hear me say it because it's animated and it's real. But when you read it, it's going to have to be like a little bit different. It's like, and this guy with it, it's like liar's poker shit. It's great. It's great. This broker was so good and so professional, but he took care of me as his customer because he respected me. Like I never screwed him over. There were people out there like that. Not everybody was scummy. I would say to him, like, after we really got close, I woke up to him on the floor and I'd say, there was a rumor, there was a story, and it turned out to be true, that he would stand at the ring and he had very, very short hair, almost bald, and very light skin. So basically he was basically like he had very Irish complexion. He wasn't Irish, but he had Irish complexion. And if you stood behind him when he had a big order, the rumor was the back of his neck near his ears would get red spots. I'm telling you, it's like out of a movie. And sure enough, it was true. And so I would walk up I'm in the options ring. So the futures ring is like the big boys, and the options ring is all the math geeks. Like we were the geeks, and they were just like the players, And so I'd walk up to him and I'd tap his clerk on the shoulder. I'd say, "Has he got one?" He's like, "Yeah." I'm like, "He's got the red spots. You're right, right?" And then I tap him on the shoulder because now I'm his customer. I'm one of his bigger customers, but I'm not a player. I tap him on the shoulder. I'd say, "Evan, I've got some stuff to sell. Should I sell it now or should I wait?" I would look to him for advice. And he would say, "I would wait." And I go, "Why?" He goes, "Well, why do you think?" I'm like, "Oh, okay." I go, "Who?" And he'd either say to me, the guy with his two biggest customers were the guy who lives in a house or the guy with two first names. The guy who lived in the house is Paul Tudor Jones. The guy with two first names was well, I'll give you a hint. The guy who's a Boston Red Sox fan here. Anyone? No one?
Buckner.
Dodgers.
Matt's got it. The guy with two first names, Matt's a Red Sox fan. The guy with two first names was John Henry. Look him up. Before I bought the Red Sox, he was bigger than Paul Tudor Jones. He was huge. I mean, probably bigger for a while anyway. Yeah, John Henry. Who's buying? He's like, I can't tell you that. The guy who bought the house. Oh, Tudor, right? Who's buying? The guy with two first names. And that would be the end of the conversation. He'd say, now get out of here. Cardinals. Yeah, but that's the thing. Look up John Henry. The guy who bought the. You remember Billy Ball? The Brad Pitt movie with Billy Bean? When he ended up going to the Red Sox, the owner of the Red Sox was John Henry. And even though Billy Ball or Billy Bean or whatever that was all about, Moneyball was about cutting costs, the Red Sox bought that championship. I'm not anti-Red Sox. I'm a Yankees fan, but I'm more of a Phillies fan. All right, so here we go. Willie Chichi, exactly. Opposite side of the Barings lease and trade, allegedly. Matt, you're referring to John Henry, right? Expos, Britt, that's a tragedy. A tragedy. I mean, look, I can't think of a bigger tragedy that needs to be in a movie, a tragedy movie, than the 94 Expos. Best team in both leagues. Would have won the series that year. And the strike killed it. Am I wrong? That was the year. Killed him. Killed him. Okay. Well, I'm going to say
sorry to break your flow, Vince, but what's your
what?
conclusion? I'm assuming, given how happy you are, you're bullish.
Yeah, actually, I'm not. I'm just drunk. No, I'm not drunk. I'm just kidding. I'm happy because I'll tell you why. I'm tell you why I'm happy. I mean, I'm bullish, and I know we're going to take that bet. I'm bullish, but I'm not bullish. You know how? All right, that's a very fair question. I have no well-formed opinion about Sunday night. Usually, if those of you not familiar, we used to do a lot of Sunday night. What's going to happen Sunday night? My preparation is about what's going to happen on the open. The market's going to drop $10. The market's going to drop $5, and I would be right frequently. I don't know what's going to happen next week, but the next moment is going to be this very short-term oriented. I don't have a good feel for that, but I'll tell you, I love the fact that macro discretionary is back. I love a couple other things. I'm going to share something with you about silver. Let me pause this. To answering your question, Scott, here's one of the reasons I'm happy. When Trump cut the deal with the Saudis, it wasn't a deal to have them invest in us. It was a deal to have them invest their oil profits in us. Whether they do it or not is a different story. Our relationship with the Saudis is very simple. When we need you to pump oil, you pump oil. When you need us to save your asses from whether it's Iran, they don't get along with Iran, or someone else, we save your ass. We sell you missiles cheap. We put troops there and we protect your refineries. Why? Because we built the Saudi Aramco facility. We created Saudi Aramco is a joint venture between the Saudis and the US oil company. That's the relationship we have with them. Do they negotiate with us and break our balls? Yeah, all the time. And right now they're like, you're not our biggest customer anymore. We're going to sell it to China. And the US is like, whoa, whoa, whoa. Hold on. We'll give you a discount on the missiles. We'll protect you even better. Give us $600 billion in the US, buy treasuries with it, and we'll give you good deals on companies that we're going to buy a piece in. Oh, okay. The Saudis are the mafia. They just do business with whoever gives them the best deal. And that's not really a bad thing if you at least accept if you're a journalist and you get hacked to bits, but that's what the Saudi relationship is. So what do? We went to the Saudis and we said, I'm telling you, this is what we did. This is what Trump did. He didn't do anything new. He just did it bigger. It's classic Trump. He went to Saudis and said, listen, you're friends with Russia. Russia is part of OPEC Plus. We're going to cut a deal with Russia. This is Trump. He's a horse trader. We're going to cut a deal with Russia, and we're going to remove all this tariff shit with Russia. And we're going to accept their oil again. But we want a lot of oil. We need, as a country, low energy prices to ensure that we can rebuild our manufacturing. Classic deal. The United States believes that with low energy prices, we could do more than the rest of the world. Now, why do I know this is true? Because when we invented shale oil, the Saudis were pissed, really pissed, and they cut a deal with us. We stopped doing shale. The Saudis were like, we're going to pump oil into shale. At the time, like oil had to be like $50 or $60 for shale to be profitable. And the Saudis like, fuck you. We're going to pump as much oil as we can until it's below those guys. So basically, the Saudis said, market share over price. And they can do that because they are the lowest cost producer of oil in the world. They don't have the most oil, probably close to it, but they're the lowest cost producer in the world. It's very shallow oil. Their cost of production is, I've had debates with people who disagree with me, and they've been found wrong. The cost of oil is between $11 and $15 a barrel. That's ridiculously cheap. Why? Because it's close to the surface and because we built in the technology that goes like this. I need more oil. Bing, they hit a button and the valves open up more. Meanwhile, you're in Iran, not Iran anymore, but back in the day, you're in Iran. We need more oil. The price of oil is up. Let's pump more. And you've got to hook up a mule to the derrick and he's got to go around faster. Like they didn't have the technology. So the Saudis hit a button. Who else has the technology? The Russians. Is all the Russian oil as close to the surface as Saudis? No. Who are the two lowest cost producers of oil in the world? The Saudis and the Russians. Venezuela is probably close, but they don't have the oil that I think they have sour oil. They have heavy oil, which is good for refining, but there's certain things. It's put it this way, we're sanctioning them, right? So now you go to the Saudis and you say, I'm giving you the premise for silver. You go to the Saudis and you say, all right, we're going to give you a deal on missiles. We're not going to abandon. Yeah, Israel's going to kill everyone except you. Don't worry about it. We promise you. I mean, I'm not saying that they believe it. And the Saudis are like, it's all in the negotiations. Saudis like, okay, would you please pump more oil? The Saudis like, all right, we'll do it. But it's going to piss off Iran. Don't worry, we got Iran covered. Don't worry, we got everyone covered. It's going to piss off Russia. Don't worry, we're going to cut a deal with Russia. And that ends. Now, I think, just speculating here, that Putin knows this. And this is the HeartNet. This part is HeartNet. We're cutting an oil for sanctions deal. Russia wants to pump oil. Trump needs to heal that relationship. The Saudis are in our pocket again. Not in our pocket, but the Saudis are willing partners again. And now Putin's like, we're not giving up any of Ukraine. Putin's a hardball negotiator, and Trump is like all crying about it. Maybe that's all. Maybe that's all. What's the word? Theater. But in the end, if it goes well, it goes well with the Russians going, okay, we'll give you back some of this, and the U.S. says we'll remove sanctions. So where the line is drawn is dependent on who's the strong negotiator. Right now, it looks like Putin is a strong negotiator because you don't negotiate away anything in a deal that you could win in the war, and he's winning as much as he can, et cetera, et cetera. So there's pushback coming out of Europe, et cetera, et cetera. Now, take everything I just said about the Saudi-U.S. relationship. This is what I said to him, and apply it to Mexico. What do you want? We want your silver. How much silver do you want? We need a lot of it. Is it the most important thing in the United States? No, it's not oil. Oil is the most important thing. Let's be clear about this. Silver shortfall in mining for the last 5 years has been covered by scrap. It's been covered by miners, not miners. It's been covered by heap leaching. That's miners. It's been covered by retail buying at $10 over spot. And so, retail is selling silver now because they're just so happy to get to break even. They're getting it. All the silver that's going into the vault in the COMEX, yeah, it's coming from everywhere. But it's coming from JP Morgan going to, not coin dealers, but scrap guys and saying, I'll take your coins. And there's thousands and thousands, and like millions of ounces being sold by retail that's just happy to get out. And the 1,000 ounce bars, I have one over here. The 1,000 ounce bars are trading at a premium. Okay, so the coins are trading at spot. I'm simplifying. The coins are trading at spot. The last bar I bought, the last 1,000 ounce bar I bought, is trading at I bought it at 15 cents over per ounce, which is expensive, but it's not dollars over per ounce, right? Because there was no market for 1,000 ounce bars because you can see the retail coming $7 over. Yeah, I need to buy it. Silver squeeze. And I'm not saying it's not real, but they saw them coming. It's the retail, like in any FOMO situation. Silver squeeze. Twitter's a big marketing tool for silver squeeze. Okay. And the bars were trading spot. I bought one at a high price, 15 cents over spot. That was 3 years ago, right? As recently as, I don't know, I haven't checked it recently, but as recently as 2 months ago, they were trading 50 cents over spot. Now, is that a lot? It's only 50 cents, Vince. Yeah, but it's 1,000 freaking ounces. So it used to trade spot. It went up by 15 cents. 3 years later, it's 15.45. It might have been like 75 cents. Let's say it was 15.45. Let's say it was 60. Let's say it's 60, right? It was like 55. So 15, 40. In 3 years, the premium on silver bars has tripled from 15 to 60 ounces, 60 cents an ounce. Why? Because every coin that's being pulled back is being melted down for bars going into the COMEX. So my point is that silver, over a long enough time frame, you're going to recoup scrap. So we're not going to cut a deal like we cut with the Saudis with Mexico. but we're going to cut a deal. Why? I'll tell you why. This is someone from I won't say his name because we're recording now. This is someone from a minter, someone who's involved in the refining process. He said the U.S. is clamping down on scrap copper being sold, exported. Apparently, it's China. China just comes in and buys all that scrap copper, and it goes out through this place in Georgia. There's a really big scrap place in Georgia. It might be in Augusta. I'm not sure. It starts with an A, I think. Athens, Georgia. I don't know, but apparently there's a really big company there, and it's not American owned. It's possibly Japanese owned, and they refine the copper. They take the scrap, and then China has been buying a lot of it, just like China is buying all the doré and all the concentrate from Mexico. So we're probably going to go to Mexico. I'm guessing. But if we do the tariffs right, we won't have to do anything. But we won't do the tariffs right. We're going to secure the supply chain. You must secure the supply chain. And that's what we do with the Saudis. Print the oil, give it to us. Print the oil, give it to us. We got oil down, right? Okay, we're going to go to Mexico. Print the silver. Notice I'm using the word print, I think like a neo-Keynesian. Print the silver, give it to us. Don't give it to China anymore. Well, what are you going to give us? Well, we'll give you some missiles. I don't know. We'll give you most favored nation. I don't know, but we're going to do that. So this is the whole, I'm giving you the long version, but the whole conversation with this guy ended with the U.S. screwed up with copper, and then they reversed it when they figured out they screwed up. They'll probably screw up with silver, and they reverse it afterwards. But between now and then, they're going to cut a deal with another country for silver, like they cut one with the Saudis for oil. And that's my story, and I'm sticking with it.
I guess on the Mexico scenario, wouldn't Mexico have to nationalize silver production in order for that to be feasible? Because right now you got private producers that are cutting deals with China buyers directly.
We all of us, at least I do, tend to think in black and white about that concept, nationalizing versus not nationalizing. I'll give you an example. In countries that are more left-leaning, socialistic, you would think they would tend to nationalize. They're more likely to nationalize. That makes sense, right? So a communist country is just going to nationalize it. Countries that are less likely to be socialistic wouldn't nationalize. They would demand that the company that's in their country sell a portion of the metal to the country itself. You follow me? Part of the offtake? They would say, we want to be your customer, we want to buy it. Latin America is interesting. That's why it's interesting. I don't know what they're going to do, but Latin America is interesting, and I'll tell you why. Latin America was extremely left-leaning, socialist, communist, but over the since the Brady bonds after the 90s, they privatized a lot of companies. So it's a political decision now. If I'm Mexico and the U.S. comes a-calling to me to do this type of deal, I have a choice, right? Britt, the choice is, do I nationalize or not? Well, if I nationalize, what happens if I nationalize? If I nationalize, I lose access to American money, which invests in Mexico. So I would need to nationalize without nationalizing. Maybe I take a 10% stake. And part of that 10% stake, which makes it, I don't know, right? But it's got to be what's politically palatable. But I'll give you real examples. I'm not just making this, I'll give you real examples. When the whole mercantilism thing started, I started watching what countries are doing with gold and copper, because Latin America is very copper oriented. And what I noticed is that in different regions of the world, they got access to their gold or got paid more for their gold in different ways. So in general, in the BRICS, if a natural resource keeps getting exported, depending on which BRIC nation, I'm not Asian, not just BRICS, the Asian BRICS, they would negotiate to get paid more for the resource. In China, they'd say, you can't have the rare earths. You can build a factory that builds batteries using the rare earths here. You build us a factory, or we're not giving you the rare earths. That's one of the things they did. Indonesia, other countries did that as well. Some countries said, you can have the rare earths, just give us more money. That was what happened out there, right? And then there was What's the country that had the coup? They just said, we're going to take the gold from you, right? Barrack, when Barrack got robbed. Mali, right, exactly. You had a coup. It's like, oh, Mali, well, let's see, we could. No, the whole region is moving towards capitalism. They're not going to nationalize. They're just going to extort the person buying. They're not using tariffs. I mean, they are using tariffs, but they're basically just saying, we're not going to use tariffs. This is where the BRICS are honest. We truly want manufacturing to be built here. So you're not going to buy our lithium and make your own batteries in the US. You're going to buy our lithium and build the battery right here and show us how to make batteries. Isn't that what China does? Right? So that's Asia. Then you go to Africa. Well, what does Africa do? Well, Africa's really not that sophisticated, at least not yet, right? So what does Africa do? Africa says to Newmont or whoever's out there, I catalog this. They said, okay, you now have to give us 5% of your production at spot. That was a big deal with the milkshake crowd. They were like, oh, it doesn't really matter because they have to swap those currencies out in dollars. But the deal was like this: an African country, I forget, it was like Nigeria or Niger or Ghana or Guyana. Ghana. It was Ghana, right? I think it was Ghana. They said, okay, we cut a deal with the country is an African country that has gold and oil, but they don't have diesel production. And you need diesel to run things. And so this country was buying diesel from another country. We don't know who, it's a mystery. Let's assume it's Russia. And this African country, I think it's Ghana, right? African country says, all right, to Russia, can we pay you in gold? We don't want to pay you in dollars anymore. And Russia's like, yeah, we don't want dollars anymore. They cut a deal. Russia's like, you can pay us in gold. And they need the diesel to run their country. So what do? They export oil and they export gold. Now, I don't know what's going on with the oil. I haven't paid attention to the oil side, but the gold side, this is what happened. They went to the mining companies in the country and they said, right now, you guys give us a fee of 10%. We don't want the fee anymore. We want 10% of the gold that you produce. And we want it in our currency. We're going to pay you with our currency. So, Ghana gets the gold in production and finds a buyer of their currency, takes the gold and swaps it with Russia and gets diesel for it. So gold is becoming money, literally, for the African nations. So Asia, except for Mali, is saying, build a factory here. We're not going to give you the rare earths. Africa is saying, give us some of the gold. They're not sophisticated. Latin America is really, really interesting. Was it Burkina Faso, Iggy? Yeah, okay, fine. So Latin America is really interesting because they were socialist. They're moving towards capitalist. And I would guess the closer a country is literally to the United States, the more capitalist they are. And that's why Argentina is important, because Argentina is more in the socialist part of the world. And now it's capitalist. Now I'm going to answer you directly, Britt. It was Britt, right, that asked that question? I'm going down a rabbit hole here, right?
Yeah.
Mexico, if you go, copper is the example for Mexico. In Mexico, I think it was Panama. Mexico wants to be paid more for their metals too. Do they want a factory built there? Nah, not really. Do they want to nationalize? Nah, they'll do it if they have to. Do they want to take a stake in their own mines? Nah, because you know what? They're not sophisticated enough. They don't want to deal with the manager of the mines. They just want the money. So you know what they did? Depending on the country you're in, you can look it up. One or two countries encouraged their mine workers, local people, to go on strike. We want more money, so pay our people. And I'm sure that they got the unions to kick back to them as well. But the point is, you're a populist leftist culture, so you encourage your employees to go on strike. Another country, I think it's Panama. This was actually on Twitter for a while. They encouraged, we're talking about local peasants who don't have a pot to piss in, protesting climate change at a mine in Panama. Who does that? And they're worried about climate. They're worried about their next meal. These people are suffering, right? Or they're not suffering. But the point is, I know how that works. The government goes to a local person and says, here's $5, go protest. That's how it works in many Latin American countries. So one country is saying to the employees, go on strike. Another country is saying, you know what? Let's protest the mine and stop work until they pay us more money. Look it up. It's probably what happened. They protested it. They slowed production. It was a big mine. It was copper. So my answer to you is, could they nationalize? Yes. For the most part, I don't think they're moving in that direction. They're moving away. They may be, let's say they're at a 70% chance of nationalizing or a 60%, but they're moving away from that because Argentina is an example of that. Argentina was orchestrated by us, my opinion. So Latin America is in the process of opening up. They've got to do business with us now. And so that's why they're doing business with China. It's like, we're going to do business with China until you kind of deal with us. Does that help a little bit?
Yeah, yeah. I'm seeing. I don't know if we have anybody from Mexico on this call, but the Morena party, the ruling party, has been going and consulting with indigenous groups, and they've been really trying to do a reconciliation,
Oh, really?
implying that there should be more wealth distributed to those indigenous populations where
Yeah.
they are on lands that are being used by mining companies.
Oh,
So
really?
it lends
You looked that
itself
up?
to
Wait,
that.
you looked
To
that
that.
up?
This is what the Morena Party's been doing since about a year and a half ago.
I didn't know that. There you go.
So they're playing that, and Trump might have changed the math on this a little bit, but it looks like they were at least using that as a threat to say we
Yeah.
could pull back, and then all your investments in our country could be, like it happens in Latin America and Africa all the time, right? So
Yeah. I mean, isn't that what the whole BRICS thing is about? If you're a populist country, let's just stay with Latin America without going down a rabbit hole. A left-leaning populist country. I'm going to reduce it to very simple terms. Bureaucracy wants to stay in charge. So government that's incumbent wants to stay in charge. So if you're a left-leaning bureaucracy or left, I think of it as bureaucracy, but if you're left-leaning government, you're known for taking care of the people. So you're going to take care of the people. You're going to buy votes, just like the Democrats do here. You're going to buy votes, but you really have to deliver for these people a little bit at least, right? And so, to your point, I'm polling and the people want more money, we'll get them more money. And then you go to the US and say, pay us, bitch. And that's it. That's part of the negotiation. You've got to in the Democratic Party in the U.S., I used to really hang out on Twitter with this hardcore leftist chick who left the left, and she's now on the right. But she would just tell me I was sucking her dry on how this operation works, and I didn't know this. I'm really, really naive on these things, but um, uh, the left uses its populism. They use the word, in America, we use the word organize. You've got to organize people. Organize people means assemble a voting bloc, tell them what you want, and then have them go do it. That's what leftist populism is. So when AOC goes out going, fight the power, everyone fights the power. She goes, can I count on your vote? Yeah. Okay. And the union votes that way, or the national, that's how it works. And she says, I'll give you a chicken in every pot. So Latin American, even if they're not lefty anymore, even if, let's say, they're left leaning but they're not socialist, or they're semi-socialist, they're going to go to those behavioral tactics. They're going to go to the village and say, what can we get for you? We need a water filter system. Okay, we'll get you a water filter system. Hey, US, we need a water filter system. How much do they cost? $500. Okay, give us $10,000. Okay, fine. You get 2 water filter systems. Are you happy? And that's what happens. So I think that it's a big negotiation, and I've gone on a tangent here, but you get the point is if you can reduce if you we're in a what's the word in Latin? Cui bono, who benefits? If you can reduce everything in this era to who benefits, you see ultimately that everything will be pushed to who benefits. So why did Russia invade Ukraine? Because in 2014 they felt they were existentially violated, and who benefits, meaning who, I don't know what the word is for the opposite of benefit in Latin. So who doesn't benefit? We don't benefit, so we're going to invade. Who benefits? The US benefits. We're not going to pay. We're not going to buy your treasures. It's all coming down to very, very arena, very Lacanian real stuff. How's that? How's that for psychology? Am I close? She's probably gone by now. Anyway, that's it. I believe Ghana is still okay. So that's it. We're done. It's 20 after 4. Jesus Christ. All right. I have some bets to make. All right, I'm back in the gambling game. All right, I may have missed some questions here. Is there anything that anybody wants to ask or add? But I gotta go, and you guys probably have to go too. I can't believe you stayed on this long. Oh, Richard, question on HeartNet. Implication was that REITs will go up with lower rates, but there are tons of foreclosures and unemployment increase. Yeah, I have a problem with that. Okay, so let me just say his question out loud here. That's a problem for me, and that's because I don't know it as intimately as my buddy does. Like, why would you buy REITs uh, uh, if a recession makes foreclosures? And I have a friend of mine who is an executive at a bank that deals in real estate, high net worth, really really high end housing in Pennsylvania on the East Coast, and malls. So he's seen the good and the bad, right? He's seen the malls. He goes, if you think the Fed's going to lower rates, you you buy REITs. And I'm like, yeah, but with the commercial real estate being shitty, what would I buy? He goes, that's the thing, you got to know which REITs to buy. So my guess is there's good REITs and bad REITs, like AAA bonds versus triple D bonds. Does that make sense, Richard? Yeah, right. I really think you got to know what to buy. And my buddy knows what to buy. I'm like, which REIT should I buy? He's like, buy this REIT. Like, this is what he would say. He said it to me before. Buy this REIT. They have big exposure in, uh, they don't have any malls. They don't have any commercial real estate in big cities. They have big exposure in suburban land. Like, you got it. Like, it's stock selection at that point. Yeah, good miners are bad. Exactly. 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 All right, guys. All right, so what's going to happen next week? I still haven't answered you, Scott, right? Or Steve? Who asked me that?
We all want to know, Vince. We all want to know.
Yeah, because I tell you, I think I've been very wrong lately. I think I've been right on the bigger picture, wrong on the shorter picture. I think, how can we not be?
Vince, you're always right when you're bullish, so just say you're bullish.
Yeah, listen, guys, just so you know, he's not flattering me falsely. The point is, I'm always right and I'm bullish is something that Scott would say to me because I'd always be right and then I would never have a position on. It's like you'd hear me say in one of these conversations for the last 2 years, I'd say it should definitely go higher. So what did you do? Well, I took half my profits. Like as I'm getting out, the market just rips through me all the time. Or you'd hear me say, statistically, this thing should go higher, but it's gold. I'm nervous. And so they would, I mean, I'm joking now, but everyone else would get, I'm Kramer. They would get long and I would hedge my bets. And everyone else would make money but me. But there are a couple things that I nailed pretty good. That was the election. But what am I now? Who's Ira Wendroff? How much should you be discounting your PTSD from operating in gold futures the last several decades? Tony, my PTSD, I'm not recording now. I'm going to tell you my PTSD is from. Anybody who understands psychology, I think, will know that I'm near the mark, but not on the mark. Trading in gold options, not futures. I was in options. So it was just as crazy, but a little bit more cerebral. My PTSD came from my childhood. I really have it. It's called complex PTSD. And what someone has told me, not recently, they'll probably tell me again when I talk to them, is that I use trading to keep my mind busy, because if there's always a crisis, here's it, Vince, you function best when you're in a crisis and you have PTSD. So if there's no crisis and your phone rings, you panic. He goes, but once the panic is over, you know how to deal with the crisis. You know what I mean? I have PTSD. So if I'm in a crisis all the time, I'm fine. It's after the crisis is over that I have a problem. Does that make sense, Tony? I create the crisis is actually what I do. I'll tell you, I did talk to one therapist who said to me, said, if you don't have a crisis, you make one.
That does answer my question. I was really looking at it from like a trading perspective, right? So you get, it's not easy trading the gold futures market because you've got Mr. Slammy that shows up every morning at 7 a.m. and sometimes they don't show up every morning at 7 a.m. And so you're overly cautious because of your past experience in the futures
no, I
market.
see what you're saying.
So I wonder, how do you discount that?
No, I'm not overly cautious because of my past experience. I'm not overly cautious because of my past experience. I'm overly cautious because of the the biography of gold. I'm always saying it might not happen. It might not happen. I take risks. Don't get me wrong. Look, I understate what I do here because you're not here to go, Vince made money. Like the chat can get like that. And I'm like, no, this is not fucking what I'm doing here. You know, I don't want to get sued someday for telling people Vince is long, I got long. That's fuck. I don't want to do that shit. But I mean, to answer your question directly, let's say that you are like that. Here's how I manage that. I do immense planning before the market opens. Immense. Now, it used to be math, it used to be numbers. Now it's looking at situations. But it really comes down to this. When I have a position, before I put a position on, who asked that? Tony, right? Before I put a position on, I know when I'm getting out beforehand, and I never, ever, ever violate it. Now, that's the hardest thing to do, to not violate it. But it's easy for me to not violate it because when I was on the floor, I'd be watching the board. I'd be, oh my God. And I would hope for it to go back up. Oh my God. And I lost so much money with that now that we're on a screen, I'm like, I put the order in and walk away. So anyway, the answer key for me, how to manage my own PTSD is to plan before you put the trade on. I know my exit before my entry. I know my exit before my entry. When I talk about Bollinger Bands, I'll say risk one to make two. That's not me just talking. My order is a stop order. It's not an alert. Beep. What do you want to do, Vince? The order's there. I'm out. It's done. It's over. I remove the subjectivity once the trade is on. That's it. That's the answer. That's my answer.
Thank you.
Sure. That's what you do. You manage your emotions, right? You know, you got to manage your emotions.
The conversation, or you mentioned previously that, if you set a stop or a take profit, don't futz with it. Just let it play out because you've already risked it. And so I'm having trouble with that myself. That's why I was asking.
No, that's a big problem. You know, the reason I had to lose money to learn that lesson, but I was academically taught that lesson in my first year. And I didn't actually start to adhere to it religiously until my 10th year. So here was my path with that lesson. The lesson was given to me by a guy named Roy Neff. You can look him up if you can find him. Roy Neff was an MIT graduate, and he was the other half of a company called Cooper Neff. Cooper Neff was a small options market making firm, as good as CRT, better than Susquehanna, better than Hull, better than Timberhill, better than all those guys. They just had a bad structure in how they ran their company, but risk management, they were the best. And Roy Neff there was a Philadelphia firm, and I was in New York. Roy Neff would come to New York and give us these amazing lectures. And one time he gave us, this is kind of where I got the whole analogy thing from. He gave us a lecture one time, and the lecture was, all right, everyone's driving a car, and you're approaching the toll booth. And the toll booth is 10 toll booths across. Which toll booth do you take? And he was saying that the toll booths are a 2-lane highway merging into 10 toll booths. he would say, you go with the middle. You go with the middle always because you're going to do it. I know it sounds crazy. He's like, you go with the middle always. And he was going through the whole bell curve. He was like, the toll booth is a bell curve. It's what a pimp, what I used to call it, pachinko or plinko or something like that, where you drop the coin and it goes down. He goes, the cars, you go in the middle because that's where you are. He goes, however, and then he would describe the whole bell curve as the toll booth. It was amazing. But the lesson that he eventually made us learn was once you commit to something, you never change. It may make you money one time. You may get to the toll booth faster one time. But once you start changing, you are now adding subjectivity. Should I change? Shouldn't I change? The key is stay disciplined. This was the lesson. Stay disciplined. And if you don't make money, if you don't get to the toll booth fast enough, then don't change every other time. Pick a different spot and go to that spot every time. And when that doesn't work, find the spot that works and go to it. Don't change once you're driving the car. And it was a great lesson. And my first 3 years of trading, I adhered to it. I was the most disciplined trader in the world at the company in options. And then when I made a little money, I was like, it's not the math that makes me make money. It's me. I'm a genius. And I started taking the other lane. I started scooting to the left. I started scooting to the right. And, first couple of times I made money. I was like, oh, really? I am real. I'm a genius. And then I started losing money. And then over the long run, my decisions were 50-50, very well schooled in Brownian motion. My decisions were 50-50, but because of something that I didn't learn about later until I read Thaler and Schiller, you want to look up, Tony, the psychology of regret. The psychology of regret says, among other things, that when you make a bad decision on the fly, it will affect your next decision. It'll pinball you back and forth. Oh, I got on my profits too early this time. I'm going to let it run. And then, of course, the market goes the other way. The psychology of regret is a compounding defeatist mentality. It's horrible. And here's why I eventually understood it and it worked for me. So I would go back meticulously to the rules that I learned from Roy Neff. And I'm like, all right, I'm just going to stay with my spot. But, you get antsy. Like, I want to take my profits. I want to cut my losses short. Lose the full amount. Don't cut it short. Take the full profit. Don't cut it short. Because once I realized I lost my train of thought. But I went back to the discipline because of Roy Neff. And then I understood that the psychology of regret was my enemy because it made me start to doubt myself, right? Some guys here golf, right? You golf. You miss a couple things. Who saw the movie Tin Cup?
Yep.
Okay. The golf movie Tin Cup. Great, great movie. And there's a scene in that movie where I went, yes, that's trading. He's at the driving range and he's got whatever it was like the yips. He sucked. He just sucked. And Cheech says to him, put your hat backwards. Put your money in your left pocket, in your right pocket. He was just screwing everything up. And the main character, Jesus, what's his name? He's a famous actor.
Costner
Yeah, Kevin Costner.
Kevin Costner,
Yep.
yeah. So Kevin Costner is like, he's looking at him going, what the hell are you talking about? And he's putting it, just do it. Just change your money to your right pocket. Put your hat sideways. I don't know, touch your ear. Doing all these bizarre things. And he started hitting the ball straight. And he goes, why did it work? And the answer is because you stopped thinking about it. Now, apply that to trading. Once you second guess yourself, you'll come back and second guess yourself again. You try and chase it. It's like a heroin high. I want to get back to it. I never took heroin, just something that I know from watching South Park. Anyway, Tony, that's my answer. Okay. So
who was the author?
I'm sorry?
The author of Psychology of Regret?
Oh, they both talk about it from different points of view. Okay. All right. There's Schiller, Schiller, and Thaler. Thaler was in The Big Short. Remember when they're at the poker table?
Yeah. Oh, yeah.
So They're at the poker table. He's one of them right now. The reason I'm going to make it clear to you, if one of them doesn't make sense to you, the other one will. One of them talks about it in a much different way. Psychology of regret is a bad decision leads to other bad decisions, or psychology of regret is when you find money and lose it, you feel like you lost money, something like that. But psychology of regret is, look, some people just need to do stuff. If I do it one by one, I will eventually figure it out the right way. Some people need to cognitively understand it. So I did it one by one. I made money. I thought I was a genius. I lost money. I read Thaler and Shaw. I read both of them. Thaler and Shaw was like, oh shit, I'm not that good. And the only reason I'm good is because I am disciplined. I'll be disciplined again. And that's why I started making money again. All right.
Great. Thank you.
Yeah, sure. All right. So I could do this forever, but thank you guys. Great stuff. I have your hopefully I have your, so you guys are going to go. I'm going to get these emails out to you. Hopefully. All right. Have a great night. Thank you for being here.
Thank you, Vince.
See you, mate.